Hello again, and welcome to session 5. In this session, we'll deal with insurance as a risk transfer measure. Just before we go into the subject of insurance as a risk transfer measure, I just want to give you some resources that you can please use when you deal with prescription, undersettlement, and theft risks. On this slide, you'll note that I've listed cases that you should please have a look at. And then these are just other resources. Please read them. They will assist you in understanding those three risks: prescription, undersettlement, and theft. And these resources will also assist you when you answer the assignment questions. When we say that insurance is a risk transfer measure, what it means simply is that the risk is being transferred to another party, in this case, the insurer. So if the law firm suffers a loss that is covered by an insurance policy, the firm will report the loss to the insurer, and the insurer will then deal with the loss and make the payment. Thus, the risk is transferred to the insurer. The first type of insurance policy that we will look at is a professional indemnity insurance policy. This is a policy that indemnifies the legal practice for firms that are brought against it, arising out of the conduct of the profession. For example, a client may say that they suffered a loss because the firm was negligent in carrying out its mandate, and therefore the claim prescribed in the hands of the firm. That will be a professional indemnity claim. Or the other examples of where the client may allege that the firm gave incorrect legal advice. That's another example of a professional indemnity claim. The LPIIF, that's the Legal Practitioners Indemnity Insurance Fund, provides the primary layer of professional indemnity insurance cover to all legal practitioners. That's attorneys, practicing attorneys, and practicing trust account advocates who are in possession of a Fidelity Fund certificate on the date that the cause of action, the error, the omission, or the circumstance that resulted in the claim. So if the attorney or the trust account advocate was in possession of a Fidelity Fund certificate on the date that the claim prescribed, that legal practitioner will be covered. The cover under the LPIIF policy is granted automatically to those legal practitioners which fall within its definition of insurance. That means that you don't need to apply for the insurance, complete claim forms, or go through any of the other processes that you go through with a commercial insurer. As long as you are in possession of a Fidelity Fund certificate, you are automatically covered. In session 6, we'll do an in-depth examination of the LPIIF and the Fidelity Fund, so I won't go into much detail here. So over and above the LPIIF cover, firms can purchase additional professional indemnity cover in the commercial market. This is commonly referred to as top-up insurance cover or additional insurance. The LPIIF cover, as we'll consider it in section 6, is granted the amount of cover, which is also called the limit of indemnity, is determined by the number of partners in the practice on the date that the cause of action arose. So, for example, a sole practitioner will get 1,562,000 rands 500. So 1,562,500 is the amount that they receive per annum, and the firm may decide that that is not sufficient to cover their risks and will thus go into the insurance market to purchase additional professional indemnity cover. So they'll purchase top-up insurance. Your top-up insurance is placed through an insurance broker, and some clients will insist that you have a certain level of top-up insurance covered in order for them to include you on their panels. The top-up insurance cover will kick in if the claim exceeds the amount of cover available under the LPIF layer. Just to explain that, so that for argument's sake, say your practice has 1.5 million rands worth of cover under the LPIF layer, but it's been sued for 2 million. The LPIF will cover you for the 1.5 million, and the top-up will kick in for the balance. So in that example, the top-up will kick in for the 500,000. Top-up will also kick in if the LPIF layer has been used up, in other words, expunged. So to continue with our example, if the firm has 1.5 million rands worth of cover under the LPIF layer per annum, and it receives a claim in August of that year, and the claim is assessed and it's paid because the firm was liable. So the 1.5 million, and the claim is worth 1.5 million. The 1.5 million rands has been used up. In October, the firm receives another claim for 1 million rands, but faced with a problem because the cover that was provided under the LPIF layer has been used up. In that instance, the top-up insurance will then pick up that claim. And lastly, top-up insurance policies pick up some of the claims that are excluded by the LPIF. We'll go into detail with the exclusions. So in what will happen, let us, for example, take a defamation claim. Defamation is excluded under the LPIF cover, but your top-up policy may cover it. It's the same with cyber insurance. Cyber risk may be excluded, is excluded under the LPIF policy, but your top-up insurance cover may pick it up. This all depends on the wording of your top-up policy as to what claims which are excluded from the LPIF policy they will pick up. This on this slide, I've just put a diagrammatic representation of what it looks like. So all claims, the LPIF layer is the base, and above that is top-up. So to go back to the example that I've been using previously, if we say that the darker blue layer is up to 1.5 million, and you have a claim for 2 million, so to go through the 1.5 million into the lighter blue, which is top-up insurance, and top-up will pick up part of it. All claims, all professional indemnity claims, will be notified to the LPIF first, and then you'll notify your top-up insurance simultaneously. The top-up insurance and the LPIF will work together in dealing with the claim. if it is found that the firm is liable, and then the two insurers will speak to each other and speak to you to see whether, first of all, the claim will be fully covered by the LPWF, or in other words, whether the claim will fall in the LPWF layer, and if it goes into the top-up layer as well, partly, meaning that it exceeds the cover available under the LPWF policy, then that insurance will also pay part of it. Or if the top-up insurer needs to check whether you still have any cover available under the LPWF, similarly, they'll check and they'll pay. In the event that there's a defense to the claim, the two insurers will also work hand in hand in defending the claim. And what will happen practically is that one firm of one legal team will be appointed to assist you in the matter. Other type of insurance policies that you consider for your practice are cyber insurance. We discussed that at length when we dealt with cyber risk. A commercial crime policy, misappropriation of trust fund cover. We also discussed that at length. You'll remember that misappropriation of trust fund cover is the insurance policy which will kick in the event that there is a theft of funds that you're holding trust, and then the fidelity guarantee or the theft of business funds cover will kick in if money held in your business account is stolen. You also need to look at an insurance policy that covers your premises and the assets of your practice. These could be the vehicle, the furniture, the computers, everything else you're having within your practice. The risks that such policies will cover include destruction, fire, theft, water damage, etc. Consider for a moment that you use a vehicle to do deliveries of documents and service of documents, and also to collect documents from clients. If you're still running a paper-based practice, and the vehicle is stolen, and in that vehicle there are important documents that are required in order to complete a mandate to the client. If in the event that the client suffers a loss, the client may then decide to institute action against you, and as you can imagine, the consequences thereof can be severe. So please look at holistic insurance solutions and insure, for example, your vehicles. Key man cover or key person, the key person cover, which is commonly referred to as a key man risk cover, also discussed in the previous session. Directors and officers liability cover will indemnify you if you, particularly in an incorporated practice, if you are sued wearing your hat as a director of a company which incorporated practices are companies, that cover will kick in the market. Is commonly referred to as D&O cover. Public liability policies also important. You may ask me, why would that be how would that be relevant to a legal practice? Consider that someone walks into your reception, a client walks into your office, and the reception area has just been cleaned, and the floor is still wet, and they slip and trip and fall and suffer serious injury, your public liability policy will kick in circumstances like that. And also because of the wide wording of public liability policies, they pick up several risks that may not be insured elsewhere. You could also look for insurance cover that will indemnify you for the loss of documents. I think that speaks for itself. Business interruption cover we also spoke about in the previous session. A credit risk policy. This is a risk in relation to your creditors. Ask your broker if they offer such if you can purchase such cover in the market. But this will assist you in the event that you for any reason you cannot pay your creditors. It's good it also helps to protect your if there's an interruption in your cash flow, your cash flow is badly affected by some event or other, that policy will kick in. As I've mentioned before, ensure that you have an experienced broker on your side who understands the type of cover that is placed for legal practices. Not all brokers understand the types of risks and therefore the types of cover that legal practices need to place. Also, ensure that your broker gains an understanding of the risks that flow from your specific practice, and that they get you insurance policies that cover those risks. Try and be wary of brokers that will just sell you general policies that will not assist you and will not assist you with the general risks flowing from your practice. You can give in order to test your broker, you can give them the scenario that I've just used with what will happen if your delivery vehicle is stolen and it has important documents in there that you need to complete mandates to clients. And also another red flag for you will be brokers who tell you that they need to sell you the insurance cover that's placed under the LPWF policy. It just shows that the broker doesn't understand that level of that layer, of cover you don't have to pay for, and that it's placed automatically. Study the wording of all your policies so that you and your staff know what you are covered for, the amount of cover, what your obligations are. So to take a simple example, if your assets policy states that you need to have an alarm and burglar guards on your premises, know what those are. It's best to know them early and not only start fighting about them when you are faced with a claim and the insurer doesn't want to honor the claim. And also know when you need to notify a claim. Some insurance policies say that as soon as you are aware of circumstances that may lead to a claim, or what is called an intimation of a claim, you need to notify them. That you'll be able to see from the wording, and also have discussions with your broker and your insurer if there are any areas of uncertainty, and also know how you go about notifying the claim. Claims are usually notified through the broker. Remember that your broker is the intermediary between you and the insurer, and the broker is your agent, not the agent of the insurer. Remember the principle of utmost good faith in insurance. Do not hide any important facts or circumstances that will jeopardize your cover in the event of a claim. If the insurer wants to know what your claims history is, what your loss history is, please inform them, because you do not want a situation where an insurer either repudiates your claim for non-disclosure, or because you made a fraudulent misrepresentation to them before they place the cover. What insurers do is that they take all the information that's provided to them and they use that to assess the risk. That will be used in the decision and whether or not they will accept your risk. And secondly, if they accept your risk, the terms on which they will accept it. I just want to yes, that's the end of this session, but I just want to point out, and if you would like to see what the differences are between the LPWIF cover and top-up insurance, please read the matter of Propel Specialized Finance Pty Limited versus the Attorneys Insurance Indemnity Fund and others. It is it's referred to in your notes, page 21. That's footnote 23. In the Porter Code that's in the Western Cape High Court, that judgment that was handed down on 30th of June 2017 went into quite a lot of detail explaining the difference between the LPWIF cover and commercial insurers. That will help you to understand the insurance structure, the professional indemnity insurance structure in South Africa, and it will also assist you in understanding the role and functions of the LPWIF. Thank you very much for joining me in session 5, and we will meet again in session 6.